All attendees are in listen-only mode.
Hello and welcome to the 8th webinar in a series covering each of the 8 levers in Equiteq's Equity Growth Wheel. Today's webinar is on the topic of management quality. I'm Paula, Marketing Director at Equiteq, based in our London office, and our presenter for today is Paul Collins, our CEO. Following Paul's presentation, I'll be putting your questions to him, so please do post your questions using the control panel on the right-hand side of the screen. The question box appears towards the bottom. So over to you, Paul.
Thanks, Paula, and thank you to you all for listening in today. So this is one of a series of short webinars which is focusing on those things of really important to buyers, and we've used our mental model of value creation to structure these webinars. And as Paula just said, the topic of today is management quality and why it's important to buyers stroke investors. So we're going to take a look at just a couple of words about us to start off with, and then I'll take you very briefly around what we call our 8 levers of equity value, and that would put some context to talking about management quality, which is lever number 8, as you'll see in a moment. We'll talk for most of the time about why buyers focus on management quality, why it's important to them, and then towards the end of the session I'll give you 10 tips drawn from our tips guide, right, that at least should give you a few pointers on where to start on this. So just a couple of words about us. We're the leading M&A firm focused exclusively in the consulting sector. We do 2 things. We work on helping companies to prepare their companies for sale. We might do that over a short period of time or over a longer period of 2 or 3 years prior to a transaction. And we have something like about 300 of our clients we're working with in that mode. The other side of our business is acting as lead advisors in the sale of consulting firms. And at any point in time, we've about 20 companies in the sale process. And have completed over 35 deals in the sector now. We operate from 3 offices around the world, London, New York and Singapore. It's a very international market, and we need that coverage to cover all of the buyers around the world. We track something like about 4,000 buyers out there who've shown a predisposition to acquire consulting firms. And if you like, our differentiating factor is that we're made up of people who come from both a consulting background and an investment banking background, and we like to think that we've got a happy mix of those 2 different disciplines to be able to provide the service that we do. So for 20 years now, we've been working on a mental model of creating value. It was first started in a company called WCI back in 1995, a firm where I led from the beginning in 1986 through to 2004, where I left that firm before creating Equiteq. And that mental model has proved to be pretty robust in terms of helping firms grow. As I said, something like 200-300 firms now have been through the use of this model. And we break it down into 8 separate areas. The previous 7 webinars in this series have looked at from market proposition through to consultant loyalty. And today we'll be looking at management quality. Not all levers are born equal in this mental model of growth. And there are 3 levers, including management quality, that have a 10 out of 10 weighting. So this is a pretty important lever where buyers are concerned. There's no doubt that strong leadership and management in any organization is key to value growth, but it's also the focus of much buyer due diligence when we're involved in selling companies. Right from the beginning of a sale process, right until the final parts of due diligence before a contract is signed, there's a huge focus on the management team itself. And as you see in a moment, right, it's by far the majority of time is spent with the management team, understanding the business, understanding the details of it, but not only that, understanding the background of the people involved, where they've come from before being in the business, what roles they play in the current organization, trying to assess their strengths and weaknesses. And there's no doubt that there are many investors out there, particularly financial investors, who say that they invest in management teams first and the firm second. So if they can identify a strong management team, there's a pretty good chance, right, that the business will be successful. So they're looking at a combination of what they would perceive as the quality of management, which might go across criteria such as their capability, the depth and breadth of the team. Do they all look the same? Do they all, are they all founders of the business, or have they found a way of bringing in different skills into the organization? The sorts of things they look at. And the reason they're doing this is that they're looking for predictability and scalability in the business that they're buying. I can remember years ago when I first started talking to the city about what they would value in a people business like a consulting firm, and I think the most common answer that I got back was no surprises. They wanted consistent rates of growth year upon year, not a top line that looked like a picture of the Himalayas or the Rockies, right, but something that had a nice straight line growth. And they would judge the ability of a firm to be able to grow consistently year on year has been a lot to do with the quality of the management team. So it's this predictability and scalability. How fast is a business going to grow, and how predictably will it grow is the big link back to the quality of the management team. So some key messages here at the very top level view is a team has to show that they're very clear on their vision and what their strategy is to get there. They need also to not be the only people in the business who are responsible for driving revenue and profit. They need to be delegating those profit targets down through the organization to the lowest possible levels possible, and then managing performance on a day-to-day, week-by-week basis. And frankly, they need to be demonstrating that they're recruiting the best that they can afford. So it's not good enough just to be one or two founders who might demonstrate excellence and great subject matter expertise, great client relationship management skills, right the way down through the organization. That needs to be demonstrated. They've also got to balance this working on the business and working in the business. When you're working in the business, you're concentrating on issues to do with clients and issues to do with staff. And if you're not careful, that can drag you down where you don't have enough time to work on the business and your strategy and your vision, and making sure that that's constantly going in the right direction. So some key items of evidence that a buyer might look for in due diligence to do with the management team and their assessments of the competence of that team. Well, on the left of this slide, they will take a look at your CV, your bio, where you've been before this business, what roles you've played in this business, what your role is today, and how that's executed on a day-to-day basis. And it's surprising just how important the strength of those CVs are often, particularly with some buyers. If you go towards the sort of strategy end of the consulting market, there's a certain element of snobbishness associated with quality of CVs. If you don't have the right schools on that CV, if you don't have the right experience there, the right qualifications, it'll probably rule you out from day one, right? So the CVs are important across the management team. Measures of leadership ability in the firm might be your ability to be able to demonstrate your understanding of the market environment within which you compete. So do you understand about your competitors? Do you understand why it is that you can be successful in this marketplace? Do you understand the size of the marketplace? Do you understand what your target audience is? What's the potential to scale in the marketplace? All of the things associated with potential scalability, the potential size of the business going forward. Have you managed to put a vision together for the organization and translated that into goals over the coming 3 to 5 years? Does that translate into a business plan that goes beyond just the financials of the P&L and balance sheet and cash flow into those activities that you've got to perform in order to deliver those goals and deliver your vision, to take the opportunity that's in the market environment ahead of you? Have you translated that into a governance structure that you can explain to a potential investor how you manage the business and how you manage towards those goals? Have you put adequate key performance indicators in place? Can you demonstrate things like plan versus actual over the last few years to give confidence to a buyer or an investor that when you tell them about your forecast, which of course always points up and to the right hand corner of a chart, that they'll have some confidence that you're going to achieve that. A lot of that has to do with your track record of having done it in the past and demonstrating that you may be able to deliver your forecast in the future. And of course, does that translate into hard, solid results? Yes, financial, but other measures of performance. Have you been good at being able to drag quality people into the organization, for example? Have you been good at developing strong intellectual property that can be scalable in the buyer's business? And on the right of this chart, can you really demonstrate plan versus actual? What this chart's showing is looking at, say, the profit and loss performance of the firm over a period of time. And if you can show that the plan at the beginning of your year you had in 2013 was the actual actually achieved the plan, that goes a long way to building confidence. But it also extends beyond the P&L to looking at things like your sales pipeline. Can you demonstrate that you're building ahead of work ahead of the business that may well not be booked workload yet somewhere in the sales pipeline? And do you have data that demonstrates in the past that your pipeline has translated into work that's then translated into profit? So it's all about building confidence in your ability to grow the firm going forward. Buyers also look for depth and breadth of management. Part of that's to de-risk individuals, right? Obviously, quite often the founders of the firm are still around. They've probably had a lot to do with building the initial growth in the firm, and sometimes there's a big dependency there. And so have you done something to de-risk that dependency on one or two what may be very powerful founders in the early stages of the business and provide that scalability? And what this slide shows are the sorts of levels in an organization that once you get beyond 1 or 2 million in sales, you ought to be thinking about this sort of client structure, this sort of organization structure. And on the top left there, you can see the level in the organization that buyer due diligence is likely to go down to, and one thing you can see straight away is it doesn't go down that far. So when we talk about management being the focus here, it really is the top parts of the organization. We've rarely seen a buyer that have wanted to extend their due diligence further down the organization than maybe the most senior client managers in the firm, and often not to that, even to that level. So certainly the board level, there would be an awful lot of scrutiny of, and maybe the direct reports to the board, there might be the scrutiny of the competence of those individuals, right? But usually not that much further down. But looking to de-risk and create scalability in the organization, you might end up with this 4 or 5 different levels. The next level down from the board might be your way of splitting the business up into separate P&Ls, and I've demonstrated a couple of different examples there, where one might be done by country if you are based over a number of different regions of the world. The next one there is showing a market sector split. If you maybe part of your business deals with, say, the pharmaceutical sector, the other part might deal with the financial services sector, and that might be one way of breaking the business up into mini P&Ls, so that there are people beyond the board who have a full P&L responsibility, probably down to the level of gross margin. Down below that, you're starting to get into looking at issues to do with client management, client profitability, client gross margin. Below that, down into project profitability, project gross margin, and all the way down through to consultant delivery at the base of the triangle here, where the vast majority of the delivery workforce should sit. Buyers also like to see compensation, strong compensation incentives that drive growth and scalability in the firm. And what I've done here is look at each of those levels on the previous chart and indicated the sorts of incentives that ought to be in place from top to bottom. And on the left there, the arrow shows an increasing amount of somebody's total compensation package that's at risk. So at the board level in a company, you should expect to see very high percentages of total compensation at risk linked into the equity value of the firm, and linked into company profitability, one of the main factors that obviously drives the value of any consulting business. The further down this list you go, you might move away from equity that might only exist in the top 2 or 3 levels in this organization structure, and then start to get it closer to a combination of company profitability, so that everybody ultimately has an eye to the profitability of the organization, and that company profit perhaps ought to be made first before we think about distributing some of that profit to the rest of the staff in the organization. But at, say, the business unit leadership level, and these could be country managers, they could be sector head managers, then there's probably something that should link directly to the profitability of their particular part of the P&L. Further down, you might be able to look at the profitability of clients. Further down below that, you could look at the profitability of projects and start to measure and assess and reward and give incentives towards that. So it's very important, I think, that when you're looking at the growth of value of a business and a buyer's looking in to see whether that's on the right trajectory, that they can see going right the way down through the organization structure, that everybody has an eye to that growth in value, to that growth in profitability. Some years back now, we sat down and said, look, there's lots of things we've learned about growing consulting businesses over the years. So let's see if we can put it into a nice, easily digestible format. And we dreamt up this idea of the 100 tips for consulting firm owners to accelerate profit and value growth. It's quite tactile. It's the sort of thing you can stick in your briefcase and carry around with you, and it's available for free on our website if you like to download it, or we can get hard copies to you. And what I've done here is I've selected some of the tips that are around the subject of management quality, and we'll just briefly go through them now. I always find it interesting that as our sector is all about providing advice to clients, that when it comes to getting advice ourselves, we're often not very good at it. There's a little bit of the old cobbler's shoes dichotomy here. So trying to get advice and listening to others, maybe others who've been through the process of building their own firm, it is a good thing to do. There's a reasonable chance that you will reinvent the wheel if you don't get that advice, and there's lots of it available out there. We have many people in our network now, beyond those who work for Equiteq itself, who've been through the task of building a consulting firm and are available as non-execs to help businesses grow themselves. So do get some advice. Probably one of the best pieces of advice I ever got when I was growing my consulting firm was go out there and get yourself a decent finance director. If you're a couple of million in revenues, you should have a finance director. You might not need them full-time to start off with. By the time you probably get somewhere between 5 and 10 million in sales, you probably need that person full-time, and it's probably the best thing that you'll ever spend your money on. So get to the point where those people who are driving clients and staff in the organization don't have to worry about cash, and that's a very good thing to do. There are certain things that leadership and management have to do themselves and take responsibility for, and you can't shirk those responsibilities. We've had situations, both in my business in the past and in other clients that we've seen, where management haven't taken the lead, and very soon you start to get problems with morale in the business, the charge that management are not taking responsibility and leading the firm. And so you just have to lead from the front on certain circumstances and take charge. It can't all be a democracy when it comes to driving a firm forward. Don't leave the future to chance. In my first consulting business, I think we got to about 5 million in sales in something like 8 years. It wasn't particularly meteoric. It wasn't meteoric because we didn't have a plan. We put a plan together and we built another 40 million in sales in the next 5 years. So actually having a plan and deciding what you want to achieve is quite important, and the chances are you won't grow very fast without one. So do put that plan in place. As you grow, you need to find a way of structuring the business to take on the responsibility to grow the firm. It can't all be done by superhuman partners, let's say, or original founders of the firm. So creating the sort of structure that was described in the last couple of slides is a way of splitting the business up and sharing the load. It's something we look for every time we see a business first time round. Is everything still being done by the founders of the firm? If so, the chances are it's going to scale very slowly. If they found a way of sharing the load, then it will grow much more quickly. Communication is all right, and as the business gets bigger, it ceases to be the case that you see everybody, all employees, every day. So you have to put more formality in communications in order to make sure that every last person in the business knows the direction that you're heading in the first place, understands where you are in that progress towards that vision, and that you just constantly keep communicating to people. It sounds simple, it sounds trivial, but you get used to in the early stages of a business when there might be only 10 or 20 or 30 people, in that it being enough to have informality in communications. Once you get above the 20 or 30, you just can't do that. So you have to invest in those communication channels and make sure they're effective. Do appoint someone senior to drive resourcing. Managing supply and demand in consulting firms is tough, and having somebody senior who can have the clout to make sure the right resourcing decisions are made, and those people sat on the bench are used before maybe some of those contractors that can sneak in through the door. It can make a massive difference on your bottom line profitability, so appointing someone in that role is important when you get to a certain stage. Keeping your critical information up to date around the place. There's no excuse these days with the power and the cheapness of online information technology not to be good users of it, so that you know at any point in time, real time, how your business is performing. You just can't make adequate decisions without that knowledge, and things can change very, very quickly in consulting if you don't get it right. It never ceases to amaze me how many firms treat things like marketing and finance and admin not as investments but as costs, as overheads that are there to be reduced rather than invested in. All I can say is that you shouldn't be doing yourself some things that functional experts are better at doing. And you should see it as an investment in the future, an investment in growth. So do invest in things like marketing departments, in admin and finance and HR, etc. It's absolutely necessary. And last but by no means least important, I've mentioned IT already. Technology is a fantastic way of leveraging growth in a firm. Somebody said to me the other day, it's a force multiplier. It's a way of really adding power to your firm, and there's great IT out there now that can enable consulting firms to grow. So I'll pass back to Paula now, and she can take some of your questions.
Thank you very much, Paul. And I've had some questions, but if I could just remind people, if you do want to post a question to Paul, please use your panel on the right-hand side, and we'll get Paul to answer your questions. So first question, Paul, that we've had in, how do you manage the potential conflict of building up the profile and skills of managers in order to attract a buyer versus the fact that managers may then wish to leave after a deal?
That's a very good question, and I'm just going to slide back to one of the slides that we looked at on this to help answer. So there's no doubt that, as I said, the focus of due diligence during the course of a sale is very much on those top two tiers. What you've got to be able to do if you are, let's say, a founder of a consulting business who has aspirations to be able to leave the firm when a deal closes, and I have to say these are few and far between, right? But if you've got into that mindset that for you a deal breaker is that you've got to be able to leave the firm when it sells, then you've got to have got to the point where your role is superfluous to the day-to-day running of the firm. So if you are in every operational activity, and if you disappear for a day, for a week, or more, the business suffers as a result, then the chances are a buyer's not going to let you leave. And that goes as far as delegating your client relationships, your business development responsibilities, such that you might be in either a non-executive or a chairman type role. It's people who have found themselves in that role, those that have been able to leave. If not, the chances are you're going to be locked in for probably 1 or 2 years, during what most buyers would call an earn-out, but it may well be a period where some of the money for your shares in the business is held back to make sure that the business continues to perform after the firm is purchased.
Thank you very much, Paul. We have time for one more question, and actually it relates back to, I believe, the slide that you were just on. So you talked about company scalability, but what's the typical span of control of a practice manager in a consulting firm?
So I think if you look at the business unit leadership line in this chart here, I found in my own consulting firm, and I've seen this being repeated in many firms since, that a unit of 10 people works really well. So if you have a market sector head who might have a number of client managers, project managers, and consulting delivery resources, a unit of 10, which roughly in most people's terminology produces revenue maybe somewhere between 1.5 and 3 million in revenue, dependent on your fee rates in your particular market sector. It is a good unit to try and build the business on. So once you've built one particular sector up to 10, you might think about creating another one. And as you build more and more sectors, you may end up with somebody who's sitting on top of those sector heads. It's a great step and repeat bit of scalability in their consulting firm.
Thanks, Paul. I will actually just ask you one more, because one more has just come in, if you don't mind, but this will have to be the last one, I'm afraid. How does it look to a buyer if we purposely slow growth or even reverse it for a year to catch up with working on the business and get the planning, measurement, policy and support systems caught up with sales?
But Paula, I'm sorry, I just missed the first part of that. Could you repeat it? I'm sorry.
I certainly can. So how does it look to a buyer if we purposely slow growth so that they can basically focus on getting the business in place with planning, measurement, policy and support systems?
I don't think a buyer would necessarily be concerned about that, but I think you maybe need to be concerned, all right, that you're potentially negatively impacting the valuation of the firm. There are, from a financial point of view, there are two factors that contribute significantly towards your valuation. One is the absolute profitability that you might have made, say in the last year or the previous 12 months, and the other one is your ability to be able to grow that going forwards. So if you've taken some actions that have reduced that growth, then it will have some impact on one aspect of the valuation equation. It may well, though, have a positive impact on some of the other factors, in that your business is seen to be more robust and more reliable and more predictable, and that might have a positive impact. Quite what the balance would be, is very individual. So we'd have to look at the specifics, right? But there's a positive and a negative there. Okay, well, thanks for your questions, and if you have any more, then please do send further through, and we can get answers back to you. And I just want to finish on some do's and don'ts, right? And again, taken out of the tips guide and relevant to this particular topic. So do spend enough time working on the business as opposed to working in the business. If you are constantly dragged down with issues to do with clients and issues to do with staff, you just won't ever have your time to get your head above the parapet and concentrate on driving the business forward. And we would argue that there needs to be a value dashboard in every consulting business that has a firm eye on whether you're driving your value towards your target valuation in the future. It's really important to do that. And last one, and slightly tongue-in-cheek this, right, but if you spent some years with your baby of your firm, building that firm over time, and then you sell to somebody, a bigger organization that probably has their own bright ideas on how that business should be run. Most entrepreneurs don't take too kindly to that. Usually we find that once you've got through a period where you might have to help your firm be integrated into the buyer's organization, that many entrepreneurs take a view that they be better off starting up their next business rather than sharing the control and the power in the organization that they spent time building. So know when's the time to leave when you get into your new home. Okay, back to you, Paula.
Thank you very much. That's all we have time for. Thank you for listening, everybody. This podcast will be available within 24 hours, and we'll be sending you a link so that you can access it again if you would like. And finally, we do provide consulting firm owners with a free resource of information in the form of articles and blogs and unique research in our thought leadership program, Equiteq Edge. You can access this via our website, equiteq.com. And finally, if you have any questions or comments, please do feel free to contact us. We'd love to hear from you. Thank you for listening.
Thanks again.